So now I'm gonna start about sharing my insight on the case that I received, that I analyzed about the banking circle and city when the PE meets fintech for cheaper, faster cross-border banking. My name is Alphin Immanuel Baroe. I'm attending financial risk management for this year in IPMI Institute. So the first thing that I'm gonna share is the background of the case. So we're gonna talk about Banking Circle and the ECT. So Banking Circle was co-founded in 2015 under the umbrella of the Saxo Bank, a Danish bank, to solve a problem with traditional cross-border payments. So the Banking Circle is a businesses that trying to solve the traditional payments, cross-border payments, specifically through what? Through the banking circle infrastructure. So the payment infrastructure that they build is a platforms that brings together all of the vital components to successfully provide real-time cross-border payments, such as their infrastructure, real-time accounts, modern tech platform, instant foreign exchange and liquidity, AI-based monitoring, and dynamic pricing. So that's all about the banking circle. So the banking circle is the business, the one that trying to reduce costs and lead times. It's just a simple technological business. EQT is a global investment investor with expertise in private equity, infrastructure, real estate, and venture capital. They have been watching this payment industry closely for years and given its rapid growth and disruptive potential. So in this case, HET is considered banking circle as an investment opportunity since 2016, but they decided pass initially the investment opportunities. Why? Because they are facing challenges in determining how the structure of the acquisition. Why? The first is banking circle was still not profitable because cash positive. Second is the equity need to assess whether banking circle could truly disrupt the highly conservative payment industry. And the third is there were also concern about competition from traditional players like Swift and emerging technologies like blockchain. So these three problems that they are facing. The first problem is like I said, the challenges with traditional cross-border payments because some people is still suitable for the cross-border payments. So there are inefficiency of the correspondence in banking. Also, there's a complexity and cost between these traditional cross-border payments. The second is the strategic concern for EQT. So the first is this the high-risk investment. This is the high-risk investment because banking circle is not profitable yet, and they're trying to disrupt the ultra-conservative payment industry. This also there's a problem in the exit in strategy and competition because, like I said, the Swift and the emerging fintech solution using the blockchain technologies on the merge, there's on the edge to be getting higher in threat. And the third is operational constraint because banking circle is dependent on the Saxo Bank. They are backed up by the Saxo Bank. So this can be very a little bit complicated because banking circle as a standalone company is a independent company, but they're still in the Saxo Bank regulation and capital requirements. So what are the causes of the problem? So the first is the cause of inefficiency cross-border payments. The first, it's inherent complexity of the traditional banking system. The second is the regulatory compliance requirement, because each transaction across border must adhere to strict regulation to prevent fraud, money laundering, etc. It's just banking requirement that's very complicated. And this third is the dependence of the legacy infrastructure because there's still less infrastructure in the banking, especially in the financial technologies. So they are still using the traditional banks. As I said before, this industry is very conservative. And then the causes of the strategic concern of the equity. Equity have the problem also. They have the concern also. The causes is the first disruptive business model with uncertainty, because banking circle is trying to disruptive the conservative uh, industry. It is a high risk to not accept it in the market. So there's a very high uncertainty. The second is the early stage development and lack profitability. Banking circle is still on this early stage development, and they are still trying to seeing the profitability. They're trying to having more stable cash flow. So this is the problem in the banking circle also that are in the concern of the HCT. The third is high competition with emerging technologies. Like I said before, banking circle are facing some competition within the Swift and the well, especially blockchain, and also with the causes of the operational concern with the Saxo Bank is the conflicting organizational priorities, of course, the Saxo Bank, traditional bank institutions. They are still in the conservative mindset, whereas the banking cycle is a agile fintech, high growth agenda, and it's very one to another. Capital requirement burden also. And there's a risk, liquidity risk, interest risk, market risk, credit risk, technological and climate risk. So the first is liquidity risk, because banking circle is still lack of probability, profitability. It is very high liquidity risk in this. Because when it comes to scaling up the business, they're still in the high growth phase, but hasn't stabilized in financial. So if we compared the banking circle as the fintech, we see that there's a table in here, a figure in here, exhibit 3. There's a years needed for UK fintech to reach profitability. Like I said, the fastest is 2 years, and the lower is in the very long years is 11 years to take profitability in the fintech in the UK. UK is the one that very advanced in the financial. There are still the people is still in the having a high financial literacy. So it's still times they need times to get profitability. So also there is an interest rate risk, of course, macroeconomic risk, and also the interest rate risk, and there's a risk between the changing of the future for foreign exchange. As the what banking circle trying to do is to disrupt the traditional cross-border payments and the market risk, because I know market risk is the competition and market situation, because banking circle faces significant market risk from growing competition in the payment space. Also, there is credit risk, client default risk, exposure to partnership, because banking circle relies on partnership with a large institution like Citibank, and various clearinghouses that also carries counterparty credit risk. So if the partner fails to meet its obligation or faces financial issues, it could be disrupt banking circle operation. Although there was a technological risk, the first is infrastructure development. As a banking circle focus on building the infrastructure for cross-border payments, there is the technological risk associated with maintaining and operating this complex system. And also the emerging technologies like blockchain, as seen in exhibit 4 in the blockchain maturity map. And they are still in the stage 2, but in the long run, and also the full commercial implementation in the recent years from 2024, there are still many years to come. Climate risk, indirect exposure to clients, because they are facing big client, like maybe they're in the future, maybe they're facing a mining client that serve so much carbon footprint. So this is going to be a pressure for them to reduce their carbon footprint. And financial regulation and green finance. So how the decision strategies made can lead to potential risk. The first is liquidity risk. So this is the risk happen because they are trying to invest in a high growth with a cash flow negative company, and they are still having investment in scaling. So for example, in the Exhibit 5, there was a fintech scaling statistic. There was a very big revenue growth. But in the meantime, scale private fintech are growing 45%. So there's a very big opportunities. So by that, big opportunities occurring a big risk because there is a very high consideration to getting a scale up the businesses. Interest risk, global expansion and exposure for market. Of course, like I said, the interest rate risk. There's a figure in here in Exhibit 6, the US interest rate and the Euro area interest rate. So as you can see, there was a very similar movement between the US and the Euros, which is, I think is good if you're trying to operate in the Europe, as they said in the case. But it will be different for the emerging markets like the Asia and Southeast Asia. And also leverage strategies. If equity attempts to apply leverage to the acquisition despite banking circle cash flow issues, rising interest rate could further strain financial resources. And then market risk. Coming in the market risk, expansion into new markets is a very risk because uh, you cannot try to mimicking the one that already exists in the market, but you try to become the one that building the market and also to capitalize the market. There's a bit of risk for you to didn't know how the environment of the market, relying on the existing competitive weakness, like Swift. If these players adopt their new innovation and regulatory changes by incumbents, banking cycle may not be able to compete. A failure to accurately assess competitive response could result in revenue shortfalls and lost market share. The risk from competitive technologies as a blockchain is also the risk that occurs in the market risk because in the operational blockchain is getting higher and higher. As you see in Exhibit 7, blockchain technology as the competition of the competition of banking circle, they're getting higher uh, year by year. From the 2024, they're in 20.91 billion US dollar, but in the projected of the 2034, for very so much big increase to 1,879 billion US dollar. Credit risk, a client acquisition strategy, and partnership counterparty risk. Like I said before, partnership can be very heavily pressured the banking circle to pressure the carbon footprint. Technological risk, reliance on current technologies. If they are still reliant on current technology, there will be a risk for that. And scalability risk. Climate risk, they are failure to adapt the climate regulation and indirectly climate exposure. So what do we need to be done from the banking circle and equity case? So for responding to liquidity risk, the first is to focus on achieving profitability because there are still a big opportunities for banking circle and equity. So there was a fintech funding evaluation profitability index from the Boston Consulting Group. Fintech equity financing is decreasing throughout the year. Revenue multiple is also decreasing. But the check compound annual growth rate for revenue was strong because they are trying to cope the new and bigger scale of the business with lower funding, and having a good revenues growth from 245 in 2021 to 330, which is at the rate of 40% for all fintech in compound annual growth rate. There's still opportunities that they can gain from this. Strengthen the financial reserves, because banking circles should build a solid cash reserve, like a banking in the normal basis, and conservative cash flow management. And then to mitigating the interest rate risk, they are trying there. The good thing is to diversify geographical markets. So in this exhibit 9, there was a global fintech landscape in numbers for global, which is this fintech is going to be very good. And then they can hedge against foreign exchange and interest rate fluctuation, because hedging is one that can lowering the risk for the foreign exchange. And the managing market risk, they can competitor market analysis, which is they can do the analysis through Swift and technology like blockchain to stay ahead, innovate the production and the differentiation, because banking circle should focus on continuously innovating its platform and services to maintain a competitive edge. Development partnership in the emerging markets is also one that very good for the lowering the managing market risk. In this exhibit 10, there was a foundation, there's infrastructure and an institution to support vibrant fintech ecosystem in emerging markets. So these all they need to consider if they're trying to get into emerging markets. There was a payment and financial infrastructure, the policies, entrepreneurs ecosystem, digital foundation, and market condition. Reducing credit risk, they can do like implement credit risk assessment for clients and also diversify client portfolio. Addressing technological risk, they can continuously invest in the technologies like AI and fraud detection, for example, cloud computing for scalability and cross-border payments. So in this scaling up technology, so these are the benefit or the digital technologies for financial services from BNP Paribas. So like we see, like the accounts cost for building account, cost of opening account is decreasing 65%. Cash in, cash out, decreasing of the cost of providing cash 40 to 60%. The digital becoming a digital in the traditional bank branch. Transaction also, the cost of supporting money transfer is decreasing from 90 to 25%. There's also the opportunity between the cross-border payment. So the bank can be very efficient if they can use banking circle very good. The total, the cost of providing financial services by doing the digital technologies can be saved around 80 to 90% of the cost. Develop a strong cybersecurity system is also the good and a very important part. And also prepare for emerging technologies like blockchain and the fast evolving fintech space that can be very, very important for the banking circle. Mitigating climate risk, they can use climate risk assessment. They can use sustainable financial regulation and develop ESG strategies. So by implementing the environmental, social, and governance ESG strategies, they not only mitigate the climate risk, but also attract clients and investors who are increasingly concerned about sustainability, especially from the developed market, from the Europe and the US. They are very eager to invest in the business that's very responsible for the ESG initiative that they have. So that's all from me. That's all for what can I share to you guys. Hope you can learn something new. Hope you can find something interesting in the banking circle and equity case. So this is a very good case because there was a problem for the banking system for fintech. There's a very complicated process for people to get investment, especially in the high capital. So, but there are also very good opportunities ahead of the banking circle to having a fintech that's cheaper, they're faster in the cross-border banking. Thank you.